Welcome to Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. My professional and academic background, I'm currently a retirement strategist and portfolio analyst for a firm in St. Louis. We manage around $100 million of retirement savings for American citizens. And also, we tend to try and advise them on how to manage their tax payments in retirement, particularly things like Roth conversions, and figure out how to minimize taxes and maximize their wealth through the rest of their lives until they pass money on to their children. I'm also teaching for the University of Maryland Global Campus as an adjunct. Until recently, I was a department chair there, and I managed their graduate accounting and finance program. Before that, I worked in the Middle East at the Dubai's campus of the Rochester Institute of Technology, where I was a chair of their business administration program. I have also managed finance programs at Northeastern State University in Oklahoma in the United States and Park University. Before I moved into my current finance career, I worked for Los Alamos National Lab as a research scientist and also at the University of Missouri Research Reactor in Columbia, Missouri. My academic background, I've got both a master's in finance and a Ph.D. in theoretical many-body and astrophysics from the University of Illinois at Urbana-Champaign. I'm also a chartered financial analyst and a certified financial planner. The CFA certification is a heavily mathematical certification, so people who go through this spend a lot of time studying things like this derivatives course, and they tend to be involved in managing money. There are a lot of them on Wall Street. It is a worldwide certification, so you can sit for it all over the world. There was a very active CFA society in Dubai in the United Arab Emirates when I worked there. The CFP certification, on the other hand, is more likely to be U.S.-centric since about half of it is based on the United States tax code. For this class, we will largely be following the Options, Futures, and Derivatives text by John Hall. This is an excellent and pretty standard mathematical text for options and futures. I've taught out of it many, many times, and I will go through the PowerPoint lectures from this text, editing them slightly to try and be more specific to the Chinese market. Well, I have traveled internationally extensively. I've been to around 50 different countries and enjoyed traveling while I was in Dubai. I have never had the opportunity as of yet to get to China and would love to do so. The closest I have been is India, Cambodia, and Thailand. So what is a derivative? A derivative is a financial instrument that is derived, or its price comes from, that of another financial instrument. The same term is used in calculus when you basically figure out the change of something, and that change of has to be of something else, just like the change of a derivative price has to be based on an underlying asset. There are various types of derivatives. Futures, forwards, swaps, and options. Forwards, as far as I know, are probably the oldest. They date back at least to the Roman Empire, and in the United States, at least, I know the history of them. They developed in the agricultural market around the Chicago area. So the way forwards developed is you had farmers in the Midwest producing agricultural products, corn, grain, soybeans, and this would have been in the mid-1800s. At the end of the summer and harvest season, they would then take those products to Chicago and they would sell them to merchants. Some years the farmers would have a very good year and there would be too many crops produced and they couldn't find a merchant to buy them, and they would end up actually dumping them in the Chicago River and going home. Other years there were droughts, there wasn't a good enough supply of agricultural products for the merchants in Chicago, and you might have a baker of bread that couldn't get enough grain to supply him through the winter to produce food for the people, and he was desperate and trying to find a farmer to supply it for him. Eventually, they got the bright idea, which again I believe had been used at least in the Roman Empire, maybe in China before this, I don't know, of signing a contract ahead of time where a particular farmer would deliver their agricultural product to a particular merchant, and maybe the winter beforehand they would sign this contract for delivery of so much grain at a set price at a set time, and this would reduce the risk for both the farmer and the merchant because each one would know their product would either be bought or sold and they would know how much they would get for it. This further lowered the risk of these two entities and also gave a feedback mechanism between the two of them so that the farmer would know ahead of time what the price he would get for grain, and if he didn't like that price, he could instead produce soybeans or corn. So this would tell the farmer what the demand for his product would be in Chicago, and he could best then meet the desires of the merchants and the citizens of Chicago for that product and make his planning decisions based on that. Well, eventually these were so popular that sometimes a merchant or a farmer might retire, want to get out of the contract, and they started trading them on bulletin boards in Chicago, particularly at the markets where they sold fish. I believe sort of like Lloyd's of London and insurance, maybe in some of the bars. They would set up bulletin boards to trade these back and forth. In time, enough of them were developed that they actually built a building, the Chicago Futures Exchange, to trade them in, where they are traded at now. The distinction would be the forwards were still the customized agreements between a farmer and a merchant, and they are still customized today and traded in the over-the-counter market, whereas futures are a more standard product that are traded on the exchanges, and they are all the same. Swaps are a combination of futures, so you might have a future that expires every 6 months for 3 years, and that would be a 3-year swap. And then options are a little bit different. Futures, forward, and swaps are set contracts where both the person issuing them, the short, like the person delivering the grain is short grain futures, and the long, the person buying them, are legally obligated by contract to either buy or sell. Options are more like insurance products. The short is the person that issues them, like an insurance company, and the long is the person that buys them. The long then has the option to either exercise the option or not, and exercise the option could be, for example, agreeing to buy grain or agreeing to buy a stock. And we will study these in the future. There are also more exotic, strange products that might be based on even things like weather futures. Why are derivatives important and how are they used in our economy? Well, they play a key role in transferring risk, and sometimes they increase risk, sometimes they lower risk. Generally, hedging is how you lower risk, and speculating is a way of increasing risk. They're on a whole variety of underlying assets, ranging from stocks, currencies, interest rates, commodities, debt instruments, electricity prices, insurance payouts, and even the weather. Examples of how you could use stocks, for example, options type of derivative. You could buy put options on a stock if you owned the stock, basically as portfolio insurance if you were worried about it dropping, but you didn't want to sell it, maybe for tax reasons, or just wanted a hedge of it going down and still wanted to be able to make a profit of it going up. Or you could buy call options on a stock if you wanted to speculate on it going up and wanted a leveraged position. Call options on stocks can also be used as incentives for management of a company, so they have a very strong personal incentive to get the stock price up, which helps the other stockholders. Many companies use derivatives on currencies if they operate internationally, so they don't have to worry about currency risk of one currency fluctuating versus another, so you could lock in a purchase price for something for months or even years ahead of time. Banks regularly engage in derivative trades on interest rates to try and hedge out their interest rate risk. If you look at things like the savings and loan fiasco in the United States, you can see how interest rate derivatives can be used to lower risk and prevent those sort of things. Commodity derivatives are also quite common. For example, in the oil industry, producers of oil might take a short position to guarantee them a sale price for some of their oil. And organizations like trucking companies or airlines might take a long position to guarantee them a purchase price. And then they can project their earnings farther out into the future. There are lots of derivatives on debt instruments, also commonly used by banks. Electricity prices, if you are a company that uses a lot of electricity, you might lock in your rates this way, guarantee yourself, or at least lower the risk of your costs going up for a certain time period in the future. Weather derivatives could be used by, for example, resorts in the Caribbean. If it's too warm in the United States during a winter, not as many people are going to fly south for vacation, and the profits of those resorts would not be as high. So there are financial transactions that have derivatives embedded all over them. It's an extremely common thing to do. Another way that derivatives can be used is in calculations. For example, corporate finance classes now commonly cover the use of real options in net present value calculations. You might look at a company engaging in a small scale project and it might have a negative NPV, but if they learn something from doing so, then they could expand that project and then that might make it have a positive NPV. So you can stick in an expansion option. So how are derivatives traded? Well, it depends on the type of derivative. A lot of options are traded on the Chicago Board Options Exchange. The over-the-counter market trades lots of forwards and also swaps. And then futures also trade on future exchanges. There are Chinese future exchanges, of course, as well. Some of the bigger ones, 4 of them, are listed here. Most of them started in the 1990s. And commodities traded on these include corn, wheat, copper, steel. Total volumes currently in excess of $300 trillion. So pretty good size, multiple different exchanges in China. Prior to 2008, the over-the-counter market was largely unregulated. Banks acted as market makers. They quoted bids and offers. They would trade forward contracts this way and swaps this way. There were generally master agreements that defined how the transaction between the two parties would be handled. Some of the transactions were handled through CCPs, which basically acted sort of like a futures exchange. In 2008, things changed, and this was largely due to things like the Lehman bankruptcy, and the over-the-counter market became more heavily regulated. The US government believed that the lack of regulation was partly responsible for the Lehman bankruptcy and the housing crisis, so they increased regulations in theory to reduce risk and increase transparency. Now the swap contracts and forward contracts are more standardized and more transparent, but still certainly not as much as a futures contract that trades on a futures exchange. So the over-the-counter market has certainly skyrocketed in the 90s up till around the time of the Lehman bankruptcy, but since then it hasn't gone up in size and may have gone down a little bit, and this is quoted in trillions, so around $700 trillion per year is traded on these. Whereas the exchanges, which would be where the organized futures are traded, is a lot smaller market than the forward and swap over-the-counter market. So Lehman filed for bankruptcy September 15th, 2008, largest bankruptcy in US history, and one of the reasons is all of the derivative risk they had on their books. It had hundreds of thousands of transactions with over 8,000 counterparties, and with that much going on and that much risk, clearly they could not handle something like the housing crisis and stay solvent, which resulted not only in the Lehman bankruptcy, but then US bailouts of banks like Citigroup. So how are derivatives used? Well, if they're used to lower risk, that's called hedging. And again, we used examples like an oil producer lowering its risk by guaranteeing it a sale price for oil, and an airline guaranteeing a purchase price for oil. So the oil company, the producer, would go short oil futures or forwards, and the airline would go long. These are also used to speculate. If you think the stock market's really going to go up, you can buy call options. And if it goes up, you would make a lot more money than if you actually owned the stock. But if the market just sits there or goes down, then you lose everything. They can also be used to lock in an arbitrage profit. We'll look at examples of arbitrage later. For example, if for whatever reason the markets get out of whack and the future price of oil is drastically different than the spot price when related to the interest rate, you can lock in an arbitrage. Also, you can do this if, for example, company A is buying out company B and the ratio of the two stock prices is not appropriate. You can also use derivatives to change the nature of a liability. For example, in the savings and loan fiasco, banks would use derivatives to lower their risk if they had floating rate loans to switch them to fixed rate loans. And you can do the same thing on the other side if you want to change the nature of an investment. So here is an example of foreign exchange quotes for the Great British Pound versus the US dollar. So we have the spot price, if you were to trade immediately in dollars per pound, is $1.45.42 is the bid, and the offer is $1.4546. This 2 versus this 6 is the bid-ask spread, and that is how the currency traders make their money. We also have a 1-month forward, a 3-month forward, and a 6-month forward. For example, if you were doing business between the US and Great Britain and you wanted to hedge the purchase of some items in Great Britain to import in the US in 6 months, you might use this forward to lock in an exchange rate. We can see that these numbers are going up slightly over the next 6 months. So that means in 6 months it is taking more dollars to buy a pound, or the value of the dollar is depreciating and the value of the pound is appreciating. So that is the forward price. Forward price for contract is the delivery price that would be applicable to the contract if it were negotiated today. So this is a legal contract that is signed between the two parties. No cash generally takes place when a forward is signed, and a forward is generally engaged in as a legal contract in the over-the-counter market. And as noted, it can be different for different maturities. This is going to be different than a futures contract, which would be traded in one of the futures exchanges. And when you sign a contract or when you buy a long or short position in a future exchange, you generally have to put up a margin to cover the possibility of loss when the price changes. This, of course, then makes forwards more risky than futures, because in the forward there isn't necessary collateral to guarantee against somebody defaulting on the other side of the contract, whereas in a future, the exchange backs all the future contracts and then forces the people that sign them to put up a margin to cover that backing. So terminology, there's both a long and a short side. The party that agrees to buy has what is called a long position. If you are long oil, you are signing a contract to buy oil at some set time in the future. The party that has agreed to sell has a short contract. That would be the party that is agreeing to deliver the oil at some time in the future. Let's look at an example. Let's say on May 3rd of 2016, the treasurer of a corporation enters into a long forward contract to buy 1 million pounds in 6 months at an exchange rate of 1.4546 0.4561 dollars per pound. It would be always a good idea to add your units, dollars divided by pound, when trying to deal with these sort of calculations. So this obligates the corporation to pay this times this, are $1,456,100 for 1 million pounds on November 3rd of 2016. So what are the possible outcomes? Well, the corporation has done this to lower risk to guarantee it an exchange. They could make or lose money by doing this, depending on, in reality, whether the dollar increases in value or decreases in value versus the pound. So this doesn't necessarily make them a profit. It could make them a profit. It could lose them money. But what it does do is it reduces uncertainty by guaranteeing them a price. This is the graph of what the profit as a function of maturity looks like for a long forward position. So K would be the delivery price or the strike price they sign the contract for, let's say $100 a barrel for oil, and then if the price of oil goes above $100 a barrel, then the long still gets to buy it at K100, and therefore they have made money from the forward position. On the other hand, if oil drops below K or below $100 a barrel, long has lost money by signing the forward position. So if they were speculating, then obviously they would want the price to go up. If they are using this as a hedging position to lock in a price, they're mainly doing it to reduce risk. Options are so-called zero-sum games, which mean for long to win, short has to lose. And this applies both to options and futures and forwards. This is unlike the stock market, where as the economy grows, in theory, everybody can make money. So here we have the graph for the long forward. The opposite of this is the graph for the short forward. Again, options are zero-sum games. So if the spot price drops below K and short makes money, long loses money. If the spot price goes above K, then short loses money and long makes money. Forwards are traded in the over-the-counter market, again, as contracts between two different organizations are a bank and an organization. Futures are more standardized than forwards and are traded in the futures exchange. So they're also an agreement to buy or sell an asset for a certain price at a certain time. They're similar to a forward contract, but they're a lot more standardized. Exchanges that trade futures include the Chicago Mercantile Exchange, which was formed by a merger, or CME Group, which was formed by a merger between the Chicago Mercantile Exchange and the Chicago Board of Trade. There is a series of worldwide exchanges called the Intercontinental Exchange. There is BM&F in Brazil. There is TIFFE in Tokyo. And there are many, many other exchanges, including those mentioned earlier in China. Examples of futures contracts. So futures contracts are all standardized. So a gold future, for example, will cover 100 ounces of gold, and you might sign a long future agreeing to buy 100 ounces of gold at $1,300 an ounce in December. Again, all of these are standardized, so a contract on British pounds versus US dollars, all of them would be for 62,500 pounds, and you might sign a short to sell 62,500 pounds for $1.450 per pound, expiring in March. All of the oil futures contracts cover 1,000 barrels of oil, so if you signed a short oil future, you would be agreeing to sell 1,000 barrels of oil, in this example at the price of $50 per barrel, expiring in April, or for delivery of the oil in April. We have discussed forwards, which trade on the over-the-counter market and obligate one party to sell in the future some underlying asset to another party at some set time. We have discussed futures, which are very standardized forward contracts, which trade on the over-the-counter market. Briefly, we also mentioned swaps, which are generally combinations of forwards. Now we will discuss another type of derivative called an option. So futures and forwards obligate both parties. It's a signed contract. One party has to deliver, one party has to accept and pay. Options are more like insurance products. One party, like an insurance company, creates and sells the product. The other party, the purchaser or the long person of the option, has the option to either exercise it or not. So under futures and forwards, both parties have to take delivery or make delivery and pay. Under an option, one party has the right to choose whether they exercise it or not. So a call option is an option to buy a certain asset by a certain date for a certain price. The person that is long or purchases it has the right to decide whether to do that or not. The organization or person that is short and has created and sells it gets paid a premium, just like an insurance premium, for taking on that risk. So most of the time, just like with insurance contracts, the long call option will lose money and the short will make money, but the short is the one that is taking on the risk and being paid for taking on that risk. A put option is an option to sell a certain asset by a certain date for a certain price. Again, the person that purchases it is long and they have the option to exercise the put, and the creator and selling of it is short, and they have to do whatever the long person that pays them tells them to do. There are American and European options. Pretty much all the options that actually trade on organized exchange are American options. So an American option can be exercised at any time during its life, whereas a European option can only be exercised on the date of maturity. We will find that in many circumstances, there's no actual incentive to exercise an option early, because if you do, you would lose what we will call the time value. Here are a series of examples of options. These are Google call option prices from the CBOE from May 3rd of 2016. So we have the strike price over here. These are call options. So if you purchase one of these options, you would have the right, for example, to buy Google at $660. If you bought this option here, you would have the right to buy Google at $680, $700, $720, $740 as we go down in this direction. As we go in this direction, we have increasing time to expiration of the option. So we all want to buy low and sell high. Since it's the option to buy Google, the cheaper you get to buy Google, the more expensive the option is going to be. So the $740 option to buy is quite cheap, but the $660 option to buy is quite a bit more expensive at $43.40, and the price increases as we go this way. Also, options are like insurance contracts. If you buy a year of car insurance, it's more expensive than a month of car insurance. So the longer to expiration of the option, again, the more expensive the option is going to be. For put options, the timed expiration is still going to be positively correlated with the price. So as we go from expiring in June to expiring in December, the price goes up. But puts are the option to sell. and you want to sell at as high a price as possible. So I would rather sell Google for 740 than 660. So as we go down this way, now the option price increases. In summary, futures and forward contracts give the holder the obligation to buy or sell at some set time in the future at a certain price, whereas an option gives the holder or the long person on the option, whether a call or put, the right to buy for a call or sell for a put for an American option anytime up until the expiration of the option at the strike price of the option. Who trades in the derivatives market? Well, there are hedgers, those that are attempting to lower their risk, typically companies involved in the actual underlying commodity. Again, oil companies trying to guarantee a sale price, airlines trying to guarantee a purchase price. These people are buying insurance contracts. There are speculators who think they know which way the price of gold or a stock or oil or cattle or grain is going to go, and they bet in that direction and make a leveraged bet, thinking that if grain prices go up, they can buy long and make a lot of money, a lot more than if they just bought the spot grain. And then there are arbitrageurs, which could be people running hedge funds. For example, big banks hire Ph.D.s in physics that are really good at C++ coding that create trades very quickly to try and take advantage of mispricing in the market. And they will try and do trades very quickly in the spot and the future market, as well as the interest rates, and try and get themselves a profit above the risk-free rate by engaging in these trades without taking any risk. Here are some hedging examples. A U.S. company will pay 10 million pounds for imports from Britain in 3 months, and it decides to hedge using a long position in a forward contract to guarantee them an exchange rate between dollars and pounds. Another one could be an investor who owns 1,000 shares of Microsoft, currently worth $28 per share. A 2-month put with a strike price of $27.50 costs $1. If the investor is worried about Microsoft making a bad earnings announcement, but they don't want to actually sell Microsoft, maybe they don't want to pay the capital gain, then they could hedge by buying 10 put contracts. Each contract covers 100 shares of Microsoft, so 10 of them covers 1,000 shares of Microsoft. And here we show a graph of the value of Microsoft shares with and without a hedge. So the blue dotted line is the change in your value, the value of your holding, as a function of the stock price change. If you buy the put contract, then you're not going to make as much money because you have to pay the put premium. But if the price of Microsoft drops below, in this case, the strike price of $27.50, which is right here, then you would exercise the put contract and you do not lose any more money. So you still make most of the profit from the price of Microsoft going up, but you pay an insurance premium to buy the puts, and they limit your downsize risk. So this is the naked owning of Microsoft, and this is the combination of owning Microsoft plus buying a put at $27.50 on the 1,000 shares of Microsoft stock. Those would be examples of investors using derivatives to lower risk. Here we can look at examples of investors using derivatives to increase risk, and they hope increasing their profits. So an investor with $2,000 to invest feels that a stock price will increase over the next 2 months. The current stock price is $20, and the price of a 2-month call option with a strike of $22.50 is $1. Your alternative strategy is you could buy the stock, and then if the stock price goes up, you make money. If the stock price goes down, you lose money. Normal stock market investment. And with $2,000, you could buy 100 shares of the stock. You could also take the $2,000 and invest it all in 2-month call options. Well, this basically creates a factor of 10 leverage. So if the stock price goes up, you're going to make 10 times as much money with the call option as you would with the stock. But if the stock price drops below $22.50, you lose all of your money. All $2,000 is gone. So that is a highly speculative position, and on average, most of the people who do this sort of thing tend to lose money. You are better off generally buying the stock than buying the option. There are certainly many dangers involved in trading derivatives since they have such high leverage. Again, most derivatives you can control with, let's say, $3,000, $30,000 worth of an underlying stock or commodity. If you are actually hedging or engaging in arbitrage, then you're either lowering risk or making a risk-free rate of return above that of a bank account. But there are many situations where traders may start out being hedgers or arbitrageurs, or at least think they are behaving like that, and they end up engaging in massive speculation. And this has created many of the derivative scandals and bankruptcies we've seen over the last few decades. So if you are in an organization that trades these things, you need to have internal controls of whoever has the right to trade the derivatives in your organization to make sure they are taking on limited risk. In the US at least, mutual funds have to disclose a lot of information to the people investing in them. They can sell to the general public. Somebody can invest in them with $3,000 or less, but they're not allowed to use leverage, and they cannot buy options and futures. They can just buy stocks. So you can have money markets that invest even less risk, bank account type funds, T-bills, and you can have fixed income funds. But none of these type of funds are allowed to invest in derivatives. Hedge funds, on the other hand, are allowed to invest in derivatives. They can invest in a whole variety of different derivative instruments, but they cannot sell to the general public. They can only sell largely to so-called accredited investors. And the U.S. defines accredited investor as somebody who has $1 million in assets in excess of their home, or makes at least $200,000 a year, $300,000 for a family. The idea is people in that asset and income class can have larger losses and be able to survive, and they're allowed to take on more risk. Also, the government assumes that they're more financially sophisticated than the general population. What type of hedge funds exist? Well, there are long short equity funds that are trying to find overvalued stocks to short, undervalued stocks to go long on. There are convertible arbitrage funds, distressed securities funds, emerging market funds, global macro funds that will try and look at anything anywhere in the world, and then some that try and do merger arbitrage, that try and figure out which company is buying which company, and then they can take a leveraged position with a hedge between those two and make quite a bit of money. I thank you for watching this video. I have also created other videos that go through mathematical calculations related to arbitrage type situations.